Welcome to Dollars and Dwellings. I'm Patrick Diamond.
And I'm Ralph DiBagnara. Welcome to our podcast.
I think we're jumping into, in this episode, you know, where we are currently, home prices continue to be very high historically, especially in the face of high interest rates. But you know, it's making affordability challenging for new home buyers, but the silver lining of that is if for existing homeowners, they have a ton of, they're probably realizing a ton of equity in their house. I think you had an interesting statistic.
Yeah, it was like CNBC put an article out, I think a few weeks back, that said there's about 30 trillion in equity in people's homes right now, which is, I think it's either the highest level or almost the highest level. I think the peak may have been in 2022 when it was around 32 trillion or something like that. But we're right there, right? Like we have all this fake money on our house that we didn't know we even had.
Right. So given that reason, we thought it would be a good reason to do an episode on home equity. What is it? How do you tap it? How do you utilize it? So that's what we're hoping to do on this episode. You know, let's start with the basics in terms of like, what is home equity?
Yeah, so equity is essentially the home in your house, the difference between your mortgage amount or whatever debt you have on it and what the house is worth. So if my mortgage is $100,000 and my house is worth $500,000, I have $400,000 in equity that's sitting there. It's kind of like a for savings, which you've said before in your house, right? But that money being locked up in your house, as great as it feels, it may not be the best use for that money, right? You know, where could that money be put to use in a lot of cases? I wouldn't say to acquire debt with it, but unless that debt is going to earn you money, right? Yeah. But you know, even at rates being close to 8% right now, it's still maybe smart for you to borrow against that house to either make improvements to your house or put that money into other investments or buy another property. You know?
And I think we'll dig into all those things in this episode. Sort of taking us back to the first episode in Dollars and Dwellings, you know, when we walked people through buying your first home, you know, we talked a lot about sort of low down payments and private mortgage insurance. And I mean, that all ties into home equity, right? Because the bigger down payment you put into your home purchase, the more equity you have right off the bat.
Which is good and bad, right? Like, you know, I always tell people don't leave yourself cash poor by putting down a big down payment.
Right, cash poor versus house rich is not a great.
It's never a good thing. Yeah, like I have all this equity in my homes, but I have no money in my bank account. So it's never good. And also along those lines, depending on where you live, but I think the majority of the United States will have increased equity over the next couple of years. Just because we're still at a huge shortage of inventory, we're still looking at bidding wars, we're still looking for prices that are rising on homes. So I think that there'll be more equity being built into your homes in the next couple of years. So if you can afford to get into a house with a low down payment where you can afford the payment and it's not killing you, I still think that's a smart way to go. I don't ever think putting 20% down is necessary ever unless you can't afford the mortgage payment. Besides that, you should really try to get into the home with as little down as you possibly can, as long as you can afford the payment every single month.
Yeah, no, great point. All right, so let's say you are someone who, whether through your down payment or just you've had the house long enough and the price has appreciated, you're sitting on some equity. Let's talk about sort of the classic ways to tap home equity, which is typically, at least from my perspective, there's three main types, and maybe you can run us through them in a little bit more detail. But there's the home equity line of credit, which is also called a HELOC, H-E-L-O-C, HELOC. There's a home equity loan, which sounds a lot like a HELOC, but is actually a different kind of thing. And then you have a cash out refinancing. So let's start with a cash out refinancing.
Sure. It's the easiest one.
Yeah, and I think at least for me, it's kind of like a mortgage in itself.
Yeah,
run us through that one a little.
A cash out refinance is essentially just taking the first mortgage you have now and replacing it with another first mortgage at today's interest rates, which is why people are a bit hesitant, right? They don't want to refinance at today's rates when they have a 3, 2, 4, or 5% interest rate. Yeah. But you can take cash out usually between 80 and 85% of the value of your home. You can take what's considered cash out. Now that cash can be taken out in actual cash, where you get a check at the closing for the proceeds. It can be used to pay off debt, whether it be credit card or auto or other debt that you want to pay off at the closing with that cash out. Those are all considered cash out refinances. That's the simplest way in a lot of ways, in the most common way to get money. We're seeing less of it right now, whereas I can tell you, being in the mortgage business, that cash out refinances are not dead, but they're close to being dead right now because people don't want to give up these low interest rate first mortgages they have right now. But credit card debt's a lot higher than that, so I think eventually you'll start to see that go on. So that, that's definitely the simplest way to do it, and that can be done through FHA, Fannie Mae, Freddie Mac, all the kind of government agencies you use to buy your homes. You can do cash out refinances through those programs. And
correct me if I'm wrong, but cash out refinancing is also basically going through the whole mortgage qualifying, closing process.
You're redoing your whole entire mortgage.
So it's that whole thing.
It's not like buying a home. Refinancing is a little less intrusive and a little easier, but you're still gonna have to prove income. You still have to show your credit report. You still have to have your home appraised. Not in every situation. In some situations, you'll get appraisal waivers, whereas you don't have to actually have the home appraised to do the. But it's definitely a bigger process than the other two options would be, which would be HELOC or home equity line of credit.
Great segue.
Yeah.
So so cash out refinancing, sort of a longer process. On the other end of the spectrum is the HELOC or home equity line of credit, which I have one, and I have mine with a bigger bank up in New England, but it was a pretty streamlined process. But take us through how do you describe a HELOC?
So a HELOC or home equity line of credit, they're both loans are second mortgages against your house. So you're not touching your first mortgage. You're actually taking out a second mortgage for that. A home equity line of credit, in my opinion, is the
let me stop you there.
Yeah.
Take for those who might not know it. Take us through first lien, second lien.
Sure.
What does that even mean in reality for someone?
When you buy a home, you take a mortgage out. That mortgage lien is when you buy a home, you get a title for the property that says Pat Diamond owns this property. Pat owes $300,000 to ABC Mortgage Company, and we have first lien position on the title of this home.
First priority and getting paid back.
Yeah, so exactly, first priority and getting paid back. So whether Pat sells the house, refinances the house, or whatever he does with it, that person has to be paid back first. Second lien position is somebody who says, okay, we're willing to lend you money. We're going to go behind ABC Mortgage Company.
So we're second in line, second priority.
Correct. So they get paid off first and we get paid off second. But when you sell the house or refinance the house or whatever you're going to do, it almost always, everything has to be paid off no matter what, unless the house gets foreclosed upon, and that's when somebody who's in second lien position could have a problem because the first lien position has to be paid first. So a second mortgage is somebody who takes second lien position on your house, and a home equity line of credit or home equity loan would kind of play both roles, right? They'd be second lien position. Home equity line of credits could be first mortgages too if you have no other mortgage on your property.
Oh, fair point.
Yeah. So they could be first mortgages if you have no other mortgage on your property, but in most cases, it's going to take second lien position.
And as long as you pay off, you pay off your mortgage, you pay off your HELOC, none of this will ever matter to you.
Correct.
It's when things go bad, whether it's bankruptcy or foreclosure, that these things would come into play. They came into play back in the 08-09 time period because I think a lot of people had essentially two mortgages.
That was very popular back then to have a first and a second. It's less popular now than it was then.
Yeah.
But a home equity line of credit is essentially a credit card against your home. You're taking let's say $100,000 line of credit for math, right? That $100,000, now you could take the whole $100,000 out at your closing and say, hey, I want to borrow overall right now, or you could take none of it out and say, they're going to give me a checkbook. You could then write checks against that line of credit, and you only pay on the money you borrow. So if you only borrow $20,000 of the $100,000, you're only paying interest on the $20,000, which is why I like them. You only pay them, and you can pay it back and pay it back, and as you do that, you can continue to take money on and off the line.
And the required repayment is pretty flexible too.
Correct.
Like I'm pretty sure my HELOC is
interest only.
Interest only for the first maybe 10 years even.
10 years, yeah.
Which is nice. That gives you a little bit of flexibility in terms of repayment and cash flow. But it also has
accruing interest. I mean, usually how it works is that you have a 10-year interest-only payment option, and after the 10 years, the line then closes. So then you can't take money on and off anymore.
Right.
So at the end of 10 years, and then it becomes...
So borrow what you want in the first 10 years.
And you pay interest, only the interest, not the principal and interest, just the interest, right? And then after 10 years, it closes, and then you have another 10 years to pay it back.
Gotcha.
In full.
Yep.
So essentially, it's a 20-year loan. But you have a 10-year payback period after the first 10 years, but you can't borrow money off it anymore.
Right. And the nice thing is, so mine's pretty new, but I'm still obviously within the first 10 years of this interest-only repayment phase. But if I want to repay principal, I can. Like
Correct.
I can basically repay everything I borrowed from it if I want to.
Yeah.
But if I want to just pay the interest, I can only
do that
just
too,
pay the interest too. So they are pretty flexible.
It's a flexible way to borrow money. It does require, it's a higher requirement than a cash out refinance would be.
Oh yeah, no, that's a good point.
Yeah.
Because I had some statistics on that. In terms of applying for a HELOC, you and I talked about this a little bit while we were prepping for this episode, but the stats I had were to apply for it, you need to have home equity of at least 15 to 20%, a credit score of 620 or higher, and a debt to income ratio of 43% or lower. We covered debt to income ratio in one of the earlier episodes, so if you want to get a little bit more of a primer on that, you can go back. But those are the statistics I have, but you had an interesting sort of real world.
I think the credit score requirements are kind of creeping up, and they're probably more around 680 than they are around 620. Mm-hmm. And you'll see those loan LTVs, which is loan to value, which means your loan compared to the value of your home, creep more down towards the 75% marker, I think, sooner than later, the 80 to 75% marker, which means they'll only let you borrow up to 75 to 80% of your home.
Okay.
And I believe you're going to have a 680 score or better. As the market starts to tighten up and credit debt goes up and people get a little bit more worried about what's going to happen, home equity lines usually start to get a little bit more restrictive. So we're in kind of a period right now where you're starting to see that. Also, what happened with Silicon Valley Bank earlier in the year and Signature Bank earlier in the year, where these smaller banks had issues, plays into that a little bit, because that type of product, although big banks do offer it, it's more of a signature product of a smaller portfolio lender.
Interesting.
Like kind of a Silicon Valley Bank, because why they usually offer the product out is because it's, for the most part, a shorter term loan. Most people don't take it to 30 years or even 20 years. Most people pay it off before that. And they can get a variable interest rate on it.
Right.
So that it's kind of a staple of their portfolio usually. So as those banks are able to lend less than they were because of what's going on.
Right. I imagine they are lending less because there's some distress in the sort of smaller regional banking area.
There's less of that product.
Gotcha.
So that's kind of playing into it. A home equity loan, right? A home equity loan is a little bit different. It's going to be not at a variable rate. It's going to be at a fixed rate, and it's going to be for a fixed term.
Okay.
So usually those work out like, hey, we're going to give you a home equity loan. It's going to be at market rate, which is going to be somewhere around 8%. It's going to be for a fixed term of somewhere between 10 and 20 years. We're going to give you all the money at closing. You're going to have to take all of it. You have no choice.
Okay.
And we're going to charge you interest on that money from day one.
As soon as it closes, interest is running.
Correct. Yes. Yeah, so you have to take the $100,000 up front, and you're going to have to pay interest on it from day one. So it's a little bit different.
Yeah.
It's more stable because you're at a certain rate and payment the whole entire time.
Right.
But it's less flexibility.
Yeah, let's unpack that a little bit, because I think that's a big thing to consider on a HELOC, is the fact that it's a variable interest rate.
Yes.
Obviously, as we keep talking about in a lot of these episodes, interest rates have gone up at a historic clip from 2022 into 2023. So if you have a HELOC like I have, I know my variable rate HELOC is, as interest rates climb, the rate on my HELOC is climbing, and that's something I don't like to think about. So we kind of, when we started a few minutes ago, we said, cash out refinancings are kind of more of a longer process. HELOCs are a little streamlined and sort of easier to set up, but the variable interest rate is definitely something you really have to consider.
For sure.
When you're choosing between one of these three products.
And they usually are based off of prime rate, and you can go Google prime rate and you can find out. Prime rate changes every single day, or not. It can, but you go look at what prime rate is, and prime rate I think right now is somewhere in the high sixes.
That's good. I should know it, but I don't.
Yeah, I should know it probably too, but I think, and usually that home equity line is prime plus something.
Okay.
Prime plus a quarter, prime plus a half, prime plus one. That's usually how they work. So you're still going to be paying a higher interest rate now, even on a home equity loan, than you would. It's going to be lower than your traditional 30-year fixed rate, but not a lot.
Yeah.
It's going to be lower, but not a lot lower.
Okay. So we covered the three types. I guess in your opinion, qualifying for one of the three harder than the others?
I think a cash out refinance of your first mortgage is the easiest to qualify for.
okay.
Yeah, for sure. Even though it's a kind of a full redo of your mortgage, it's still the easiest one to qualify for because the credit score requirements aren't as heavy, and banks feel a lot more comfortable when they're in first lien position. Second lien position is going to take a little bit more trust, which is why they want a higher credit score and a lower LTV, right?
Okay.
So to be in first lien position means that, and this has come into play recently, and I don't know if I brought this up on a previous episode or we've just talked about it, but there's something that if you look up the term, it's called ghost mortgages.
Oh yeah, I didn't know about this until you told me.
Yeah, which is interesting because this plays into that, right?
Yeah.
Like we said before, back in the 2000s, it was very popular to have a first and a second mortgage. A lot of what happened when homes started to be foreclosed on or go into bankruptcy and stuff like that is these second mortgages couldn't get their money because there wasn't equity in the home to take their money back. So what most of the banks did or the investors did is they wrote off the debt.
And let me jump in.
Yeah.
At least from my, when I was doing legal work back then, and I was working on some cases or around mortgages and mortgage-backed securities, especially second liens. Back then, people had two mortgages on their properties, the first lien and the second lien, because it allowed them to put basically zero down. They borrowed the whole amount.
Piggyback loans.
Yeah, so if you were basically buying a $500,000 house, you 75% of it was your first mortgage, and then you could take out a second lien for the rest of it.
A lot of it was called 80-20s. They were doing these 80-20s, 80% first, 20% second.
There you go.
So these seconds became kind of like, something that were useless almost. So the banks wrote the debt down, which I'm sure a lot of.
The houses were so underwater.
Correct, that they couldn't pay off the second mortgages when they were sold and or refinanced. So what most people thought that had these mortgages was like, oh, they were forgotten. Everybody stopped collecting payments on these. I guess it's over.
Right. Nobody's been bothering me for a long time,
10 years.
So I just forget about it.
It's over. Yeah. What happened is these savvy investors started to go around and buy up the debt for like 20, 30 cents on the dollar from what they were originally worth. And now that people have record equity in their homes, they're saying, hey, when you go to sell your house or you go to refinance, hey, I'm still here. I'm in second lien position.
You may have forgotten about me.
Yeah, but I didn't forget.
From years ago.
You owe me this money.
But now that your home's worth a lot again, I'm back.
Yeah.
And
so it kind of gives you...
and it's not funny, but like these are serious commitments.
Yeah.
These are
and the debts that everybody thinks they forgot about. So if you were one of the lucky ones who sold your home before they could come back and get you, great. But if you're somebody who still owns that home with mortgages back from then, they're going to come look. Somebody's going to come looking for. If it's on your title report, and you get a title report for every home you buy, if there's a lien in your title report, it's going to have to, when you go to buy a home or sell a home or refinance a home, that title report has to be cleared. Every lien on that title report has to be cleared off or has to be spoken for. So somebody's going to ask the question. And they're going to have to contact the lien holder, like, hey, what's the deal with this? You're in second lien position. And he's going to say, yep, I got a mortgage note here for $40,000 or whatever it is.
That's an interesting.
So, it comes into play. But like I said, second mortgage lien holders want a little bit more security. So they're going to have higher requirements a lot of the time.
Okay. Okay, so let's assume somebody's got equity in their home. They qualified for their HELOC. They tapped their HELOC. Let's talk a little bit about sort of uses of that money and tax implications of that money, because those are two important things for anyone who's considering tapping their home equity. Again, going back to our first episode, we talked a lot about primary residence and special tax attributes of your primary residence. You used to be able to deduct any interest from a second lien loan like a HELOC, but back in 2017 those rules changed. So now if you do tap the equity in your home through a HELOC, it's not necessarily tax deductible.
Not the same. So essentially the rules are, depending on where you live, this may be a lot or a little. And most people it's a lot, but you're able to write off up to $750,000 in mortgage interest. Total. So between your first and your second mortgage. So that means you only can write off the interest payments on mortgages up to $750,000. So if you have something above and beyond that, you can't write it off.
Right. So if you have a giant mortgage, whether just a first lien mortgage or a combination of the two, if it exceeds $750,000 in total value, you're capped at the $750,000.
Correct.
So if you're borrowing, say, over $1 million, you can't write off you can't deduct the interest over the $750,000 up to the $1 million.
That's correct. And then on property taxes, which you can write off as well, you're able to write off up to $12,000 in property taxes. So in most states, that is enough. In the state we are today, which is New Jersey, it's not enough. It came out this week that we'll get into that the median tax in New Jersey for an average homeowner is like $8,700. So a lot of people in the state don't qualify for, you can still write off up to $12,000, but anything above and beyond $12,000 you can't write off. So it's something to think about, but you brought up a good point. Like that home equity loan, if you take it out and you use that money, you can write off the interest as long as you're not above $750,000.
But the other requirement is you have to use those funds to basically go back into the house. They have to be used. I think I'm going to forget the exact IRS term, but it's like substantially improve
the home.
The home.
Yes.
So the idea is there, going back, I know we like to go back to the sort of 07, 08, 09 time period, but a lot of people got in trouble back then because they were tapping the equity in their homes, but then using it to buy a car, go on a vacation, run up, buy stuff,
the main
clothing,
reason to take
and
home
jewelry.
equities used to be called the home improvement loan. It's not, people don't reference it that way anymore, but when I originally came into business in those years, it was the home improvement loan. I took this HELOC out, I'm going to make improvements to my home because that's how you can write it off.
Yeah.
But that's not, in most cases, like me and you've talked about it, like I'm going to use it for what it's needed for because I can take the money on and off. It's like, it's like having a checkbook.
Yeah.
It's nice, but you have to, for the tax purposes, you have to be careful what you're using it for.
Yeah, certainly in my world, in the financial planning world, we don't want to see clients tap their equity in their home to spend it on, vacations and clothing and things like that. For the very fact that we just touched on, it's a variable rate, it's going up, but if you're using that money to put it back into the house and then you're basically increasing the value of your home, that's a really great use for it.
Yeah, and this, for somebody who has a home equity loan right now who's thinking about taking that money and investing in a business or buying something else, just be conscious of the fact that if you can use your cash for that portion of it and then use the home equity line to put the money back into the house, you're better off doing it that way.
Yeah.
If you have an option and you're going to do both anyway, I'm going to make improvements that I was going to pay for it and I was going to use the home equity line to invest in something else. Switch, right? Use your cash to actually invest in the business and use the home equity line to invest in the home because that's when you get the tax benefit.
Great tip, yeah.
Yeah.
And in also, I think in episode 2, we talked about the idea of emergency funds and budgeting for maintenance and repairs in either your primary residence or in investment properties. And I gave the sort of the standard rule in my world, which is, an emergency fund of 3 to 6 months of fixed expenses, and you rightly said, in your experience, you know a lot of people don't have 3 to 6 months of fixed expenses, but having at least 2 months of mortgage payments in the bank is a nice idea. I think where a HELOC can be a useful thing is that if you don't have those cash savings, whether it be the 2 month of your mortgage payments, a HELOC is something you can set up and basically have ready to go in case you have an emergency.
It's like an emergency line,
right?
Which is half of the reason I have one on my home now that I didn't need when I took it out, and I haven't needed it yet, but it's there. Right? Mm-hmm. If something comes up that I need a large sum of cash for, or I don't have the cash, I have it as an emergency. So I had the equity in my home. I went and took the home equity line out, so I'd have it, and it'll be there for 10 years as kind of a buffer for me if I need it. And that's really a lot of times what it's meant for.
Right, and we made that joke, water heaters only break in winter.
Yeah.
Having a HELOC would be a good use of that money.
Things constantly go wrong.
Yeah.
You know what I mean? Like I live in a newer home and I still had to do something with my HVAC system the other day. A little part was $1,200. Mm-hmm. Like the water heater goes, that could be a $4,000 to $5,000 expense. Like things happen when you own homes. Like, so if you're not handy yourself, and I am not handy, I can't screw in a light bulb. So we also an episode when we talked about sort of the cost you don't think about in a home, and I just had we're heading into colder months here in the Northeast, so I just had the furnace service guy come. I have an oil furnace in my house. My furnace is original to the house. Yeah.
So every time the service guy comes every year, he's always like, "She's old, but she's running." I'm like, all right, that's all. That's good news.
Yeah.
But this year, I don't know. The guy dug a little bit more deeper into my furnace, and he gave me the bad news of like, you probably only have a year or two tops on this furnace. And I didn't appreciate how much a new furnace costs, and it varies depending upon whether it's electric or oil. But I could easily be looking at a $6,000 to $8,000 bill.
Yeah.
But I was like, my HELOC.
Yeah, I can use it. And listen, and going into houses, especially now, you just made me think of something by saying that. People are willing to compromise a lot to buy a house right now because it's very, very hard. The bidding wars and everything else, which we've spoken about before. Be very careful before you buy homes with oil, or like, you have to look into these things as far as expenses, because that can become a huge expense. I have two houses actually that have oil, and they're in cold places. It gets expensive, and gets expensive in the winter. Like, and it was something I didn't really budget for those properties. They're doing well enough as investments that it's okay. But it was not in my budget, I mean, that I'd have to spend $1,000 every few months to refill the oil, you know what I mean? So it's just something to think about.
Oil is creeping up above $90 a barrel.
Yeah,
it's going to be, for the winter heating season is going to be an expensive one for those of us with oil. It is something
to think about.
Yeah. All right, coming back to home equity, I wanted to just touch on sort of a unique item, which is, how does home equity and tapping home equity play into financial aid if you have college-age children or high school-age children?
I'm curious about this, actually.
Yeah, this is a good thing to sort of keep in mind. A lot of people ask the question, okay, I have a lot of home equity in my house. Is that going to impact me when it comes time for my kids to qualify for financial aid to go to college or graduate school? And the answer is it depends. It kind of depends on which schools you're applying to. Most people know about the FAFSA. It's from the Department of Education. It's a form you have to fill out and submit to the federal government, and it basically qualifies you for federal financial aid, whether it be loans, grants, work study. The FAFSA does not take home equity into consideration. Most colleges and universities are FAFSA schools. However, most of your more selective private universities, talking like Ivy League schools, things like that, the Dukes of the world, they are called CSS profile schools. Don't ask me what CSS profile stands for, I don't know, but it exists. And the CSS profile schools, when it comes to qualifying for, when you are seeking aid from a CSS profile school, you're basically getting it directly from the school.
Got it.
Not from the government.
So they want to know everything.
They want to know everything, and they're a little bit more savvy in terms of getting your full financial picture.
Got it.
And one of the things they want to know about is how much equity you have in your home. So the tip kind of when it comes time to applying to colleges, if your child is someone who's sort of casting a wide net and applying to a lot of schools, and you have a lot of equity in your home,
really interesting.
You want to apply to some FAFSA schools and some CSS profile schools and see and kind of see which aid offers might be better than the others.
That's very interesting. I didn't know that, but that's a great way to prepare for it.
Yeah, the world of financial aid is a complicated world. I mean, I could do a podcast series. I'm sure people have done podcast series just on financial aid. But home equity comes into play sort of in an interesting way there. So, so if you're someone with college-age kids, keep that in mind. Your home equity may or may not be counted depending upon the school you're looking at. All right, here's a question. I've asked you this question before. So when it comes to a HELOC or tapping your equity generally, how much can you actually tap? Like, let's say I have $1 million home and I've paid my mortgage off almost entirely. I'm sitting on a mountain of equity. Could I really take out like a $800,000 HELOC?
Yeah, banks will lend you up to 75. Most of the home equity lenders, or some of them even, you'll be able to find one, will lend you up to 75 to 80% of the value of your home, whether that be $2 million or
$200,000.
Or $200,000. Yes, so you can really take out that much money. They're looking at the risk factors. Equity in your home is equity in your home, right? So whether it's $1 million or they would prefer a lot of these small portfolio banks would prefer the larger amounts.
Interesting.
Because it's more interest.
Right.
That's really how they make their money. Whereas as some of the bigger banks like Chase and Wells Fargo and Bank of America, believe it or not, as the general public thinks that they're crushing it with it's not really how they make their money. They're really trying to get your money from other things, not the mortgages. So,
and I've seen it with clients. I've seen clients that have tried to take out small mortgages on a home, and banks don't want small mortgages. Like if you've paid your mortgage down enough, like you're probably stuck with it. You're not going to be able
Banks
to.
don't want small mortgages.
Yeah.
It doesn't benefit them.
So let's say a large HELOC versus a small HELOC, same interest rates?
In most cases, it's the same interest rate. They're going to be prime plus something. In most cases, they stay the same. There's not huge adjusters for that. I haven't seen really, loan amount adjusters on that, to be totally honest with you. In most of the cases, they're the same.
Interesting.
Yeah.
All right. So we covered the types. We covered applying for it. We covered tapping for it. We talked about taxes, and we even covered repaying it with your sort of 10 years of interest only, and then a sort of closing, and then a 10-year principal repayment cycle. I think we've covered a lot on home equity. I think I'll sort of wrap this up by saying, from a financial planning perspective, home equity lines of credit we like to say they're very good tools in the toolkit for a lot of the reasons we talked about. You can basically qualify for it, but not tap it, and so you're not really incurring any fees or interest payments until you need it. So that way, again, it's a tool you just have ready, especially for those entering into retirement. And correct me if I'm wrong, all of these are easier to qualify for when you're still working.
Yeah, they're not easy to qualify for. When you're not working, I actually just went through this with a family member. He sold his business for a significant amount of money. He retired, and even though he had all this money in the bank and these payouts and all this other stuff, he couldn't get a mortgage.
Right.
He couldn't get a simple mortgage. Yes. To get any kind of mortgage, including a HELOC, you really need to have money coming in.
Because they're going to want to see pay stubs, essentially.
Yeah. Banks want to feel secure that you have monthly money coming in to make your monthly payments.
So it's a good tool in the toolkit. It's easier to get while you're working, especially if you're a W-2 employee and you have pay stubs coming in. So qualify for it, set it up, and again, have it there ready. So when you go into retirement, like Ralph said, it's basically a 20-year loan. So setting it up before you get to retirement could be a really smart move, because there's no cost to setting it up and just having it there ready to use.
Yeah, it's a really great point.
All right, we have the email address on the screen.
Yep.
If there's something
you want to hear,
something on this topic that we didn't cover, or you want us to, or you just have questions in general, please submit them. Ralph and I will get back to you for sure. But I think that covers home equity.
So it was interesting. I even got some stuff out of that. The college stuff is interesting to me right now.
Usually Ralph's the one teaching me.
I learned today.
In all these episodes. All right, I taught him something today. So, all right, we'll wrap it up there. Thanks for tuning in. We'll see you on the next episode of Dollars and Dwellings. I'm Patrick Diamond.
I'm Ralph DiMaggio. Thank you.
Yeah, we'll talk to you soon. This is your co-host, Patrick Diamond. I'm a vice president and certified financial planner with Wealth Management Resources in Smithfield, Rhode Island, where I serve our investment customers as an investment advisor representative. My co-host is Ralph DiMaggio. Ralph serves as president of Home Qualified, the digital resource for buyers, sellers, and real estate agents. He's also vice president at Cardinal Financial, a nationally recognized mortgage loan company, and he's the recent author of The Growth Trap, a continuous plan to avoid the traps of life and build a better you. Our discussion is not tied to the offer or sale of any investment products or products in general. This podcast is for informational purposes only and is not meant to be legal, tax, or investment advice.